In this video, I'm going to break down partnership taxation basics and basis, which is a common concept for partnerships. So I'll be explaining how a partnership is taxed and how to keep partnership accounting records, because that's what gives you the information you need for taxes. And all of this will lead us right into what the multi-member LLC or partnership business needs to keep track of itself and what individual partner members need to keep track of on their own, because the business won't be doing it for them. If you've been confused by what you find online, I don't blame you. There's a lot of technical textbook type examples which tend to be disconnected from reality. I'll be showing you my partnership worksheet calculation in Excel, which compares the three types of member partner basis calculations, which I'll be explaining more momentarily, and we'll be looking at my multi-member LLC business spreadsheet template. Now, like many things taxes, the partnership taxation is quite complex. But I'll be explaining the differences between inside and outside basis, capital account, tax basis. So if you've been hearing these terms when you're trying to figure out your partnership taxation, I'll be clarifying the differences in this video. Now, I do have other videos that will go through the individual calculations, the differences, and paying yourself, and you'll find the links to those in the description below. However, I highly recommend watching this video first. My name is Amanda. You're watching The Business Finance Coach on YouTube, where I simplify business to help small business owners succeed. I'm the creator of the Small Business MBA, which is an online program that helps business owners step by step to set up their LLC, their business, accounting, taxes, and legality, all in one online e-course. I give away a free version of the spreadsheet template that's in that course called the Free Business Spreadsheet Template if you need help with accounting, quarterly taxes, and end of year taxes, all covered in there. So there's links in the description below to everything I just mentioned. For now, let's get back to partnership taxation. First, let's just go over who exactly partnership taxation is for. We have legal business types of multi-member LLCs, meaning there's two or more members, and partnership businesses. Now, both of these types of businesses default to be taxed as a partnership. Now, if they qualify, they can elect to be taxed as a corporation and then taxed as an S Corp. And an S Corp combines aspects of the corporation and a partnership, and it's really a common tax type. So how is a partnership taxed? A partnership is called a flow-through entity because the activity from the business flows through to the partners. And so the business itself pays no taxes. And this happens on Form 1065, which is the business's tax form. The business form reports all of the business's activity, income, expenses, other income, other deductions, and then all of these amounts flow through onto Schedule K-1s. And there's a Schedule K-1 for each partner attached to the Form 1065. So all of the activity is reported to the partners based on their ownership percentage. Each business has 100% ownership share, which it can allocate between its owners. So all of the amounts on the Schedule K-1s need to add up to the amount on the 1065, just like all of the partners' ownership percentages need to add up to 100% for the business. Then each partner reports their Schedule K-1 on their personal Form 1040 for their taxes. That means that the business must file before the partner can file their own personal tax form. They report the Schedule K-1 just like they would a W-2 or a 1099. However, that's where things get more complicated because unlike a 1099, which has one number, the Schedule K-1 will have often many different numbers because it's related to the business activity. When that business activity flows through to the K-1s, it retains its character. That's a tax phrase, which means if the income was interest income for the business, it's interest income for the partner on their personal return. If the income was rental income, then it's rental income on the partner's return. So let's flip over to Form 1065 and Schedule K-1, and I'll show you what this looks like. Form 1065, U.S. Return of Partnership Income. So this page 1 reports what the business actually does. So this is going to be the ordinary business net income or loss. The income is reported on top and the expenses reported on the bottom. That gets us down to this ordinary income or loss line 22. Now you'll notice this income doesn't include things like investments, dividends, or interest, sales of things. This is only for what the business is in the business of doing. That's why there's cost of goods sold, gross profit, ordinary income or loss. Now down here are the expenses. We have salaries and wages first, and that refers to W-2 employees. But that does not include any payments to the partners because partners, which could be members in an LLC, are never taxed as W-2 employees. Now, if they're receiving a regular payments, that like a salary, that's under guaranteed payments to partners, which is a deduction for ordinary business income. However, I don't want you feeling like that's a deduction and a better way to do things, because at the end of the day, it doesn't actually make a difference. And I'll go into more detail in that in my video about paying yourself in a partnership. Many expenses will just go under other deductions with an attached statement if they don't fit into any of the other categories. So that gets us to ordinary business income or loss, and a lot of people see this tax section at the bottom and get confused. These are not taxes that are often applicable to partnerships. So that's the main business activity. Now, page 2 and page 3 are just based on informational questions. Page 4 is Schedule K, and this is where everything is divided out, and it's from Schedule K that all of the information flows to the K-1s. So we can see that final net income or loss from page 1, line 22, it's reported first. But then we have two other main types of income: net rental real estate income or loss, or other gross rental income or loss. So if you have amounts in more than one of box 1, 2, or 3, then you should have additional statements attached to your partnership tax return that explain how any activity listed below is related to these different activities. Essentially, it would have made more sense for them to just require a separate Schedule K to be used for each activity box 1, 2, and 3. These are the 3 main activities for partnership net income or loss. Then we have these called separately stated items. We can see there's interest income, dividends, capital gains, sale of business assets, that's Section 1231 property. Section 179 deduction is a special type of depreciation. Contributions means charitable contributions. So the business doesn't take it. Instead, it goes to your own personal return to see if that partner will qualify for those charitable contributions or not. Investment interest expense, that was a Schedule A deduction. Net earnings or loss from self-employment, and this is where the taxes really come into play. Again, be sure to check out my being paid in a multi-member LLC partnership video. So these are other less common items down below here, and then these last lines are just informational as far as the categories. Page 5 of 1065 is not required for small businesses, very small businesses, but once it is required, it does bring on a level of complexity. Essentially, the purpose of this page is a check from your book accounting records based on tax changes to get to your tax numbers. And it includes looking at the partner accounts. It includes looking at the balance sheet, both book basis to tax basis at the beginning and end of the year, and then reconciling, okay, what was your net income on the books? Let's account for all those tax changes and then get to net income or loss on the return. And then same thing with the partner capital accounts. So that brings us over to Schedule K-1. This is the form that each partner gets, and that there's one attached to the 1065 filed with the IRS for each partner as well. Part 3 here is where all of those Schedule K items are being reported to the partner. Often under many of these blocks, you'll see multiple lines, and that's where there can be a letter in the box that indicates the type of amount to the right of it. And on page 2, you'll see there's codes for what the letters mean in different boxes. So for line 11, code A means other portfolio income. Code C means section 1256, contracts and straddles. How is partnership accounting handled? So all multi-member LLC and partnership legal businesses, they must, for both legal purposes and tax purposes, keep a complete and accurate record of everything that happens in the business that affects value. Now, this record should be maintained daily and should include everything that happens in the business that affects value. This is my accounting spreadsheet template for multi-member LLCs, and you can see on the income statement, there's an area for everything that's increasing the bank account and then an area for everything decreasing the bank account. Of course, commonly we have income sections and expense sections to know how profitable the business is, but there's also a line for each partner or member in the business so that we can track any money they put into the business account and any money they take out of the business account that's not a guaranteed salary payment. So all of that activity is affecting that partner's account. Now, the next main point of accounting records is called the balance sheet. It's a report. It's really the highest level report for a business that represents everything happening in the accounting records for that business. The balance sheet, which shows assets equals liabilities plus owner's equity. Now, that's an equation that is always true for business accounting records that are kept correctly. So assets are everything the business owns is equal to liabilities, everything the business owes, plus the owner's equity section. And this is our first category of calculation for the member partners in a business for partnership taxation. So let's zoom into that section. So here we have the owner's equity section, and we can see that there's owner capital. And then we have retained earnings, and this is the net income from each period, which is coming from our income statement. Total revenue minus total business expenses gives us net income. So the income statement is based on a period of time, right? Whereas the balance sheet is based on one day. As of today, this is the value of the business. So the capital accounts essentially account for increases to the bank account, anything that the business owner is putting in and anything the business owner is taking out. And that's what the capital account is. However, if we flip back to our Schedule K-1, we have the partner's capital account analysis. And so this is essentially coming from the accounting records, that partner's capital account. However, our current year increases or decreases are going to come from that retained earnings section. So although retained earnings is not allocated to the partner accounts in the accounting records, it is done so on the Schedule A partner's capital account analysis here under section L. But where confusion comes in understanding these three calculations is that this first option is tax basis, which is what most small businesses are going to check. However, the next two calculations that we're going to learn about for partner members are often also referred to as a tax basis. Next, let's go into basis and what the next two calculations are for members. What is a partnership basis? The word basis is a common tax term that means your investment value in any asset. An asset is anything that you own. So whether it's a real estate property, stocks, or a percentage of a partnership business, what you paid for that asset is your basis or your investment in that asset. Then, as you go throughout the year, as activities happen, income and expenses occur, these different things will affect the basis by increasing it or decreasing it based on the specific rules for that type of asset. So there are different rules for stock, for rental properties, and for business partnership percentages, of course. So when you initially purchased an asset, you start with the beginning basis amount. And this often starts at zero or cost basis, which is what you paid for it. When the asset is sold, whatever the adjusted basis is at that point in time, you will take the sale price, including everything you effectively received, doesn't have to be cash, minus everything you gave up, which is your adjusted basis. And if everything you got was more than what you gave up, you have a gain. If it's the other way, you have a loss. Partnership basis works essentially the same way. A partner owns a share of the business for whatever cash, services, or assets that they contributed for that portion. Now, cash is the only straightforward one, so we'll use that as an example. If someone put $10,000 into the business in exchange for their 50% share, then they own 50% of the business with a starting basis of $10,000. However, this is where it immediately gets more complicated because with a partnership, we actually have two perspectives. We have the business's perspective and how the business treats things, and we have the partner's perspective and their individual investment in the business. So the business's perspective is our second calculation, which is called inside basis because it's inside the business. And so this is a basis investment calculation based on the business allocating the assets to the partners. Then the outside basis is what each partner needs to keep track of on their own for their investment in the business. Let's jump into the basis calculation worksheet. Here we are in the partnership basis calculation worksheet. And one concept to understand is that partners have to pay tax on their share of the net business income, that ordinary partnership business income, regardless of how or if it's actually distributed to the partners. And so that's where a lot of the nuances of these basis calculations really comes in because it prevents manipulation of taxes, essentially prevents people from avoiding taxes. So this spreadsheet is to illustrate the basis concepts of outside and inside basis and the capital account. So the concept of inside and outside basis, it is similar. Starts with beginning balance, adds this section of increases. That gives us beginning balance plus increases, then minus decreases, and that gives an ending balance. And basis is calculated each period, usually a year. So outside basis, this column is each partner's personal basis, their investment in their share of the business. And then inside basis, on the other hand, is essentially the allocation of the value of the business to its partners. And remember, the capital account, alternatively, is just based on the accounting records and is primarily based on contributions and withdrawals. So if we look at the inside basis tab, we can see that we have a column for each partner because remember, this is from the business's perspective, allocating all of the assets and value to the partners. I'll be doing more detailed videos on these calculations. Well, that's all, guys. To review, we covered partnership taxation. We went into the actual tax forms, we went into how to do the accounting, and then we looked at the capital account for a partner, as well as inside basis and outside basis. Remember, I have other videos that go into more detail about these areas. Don't forget about my free spreadsheet if you're interested in that. Otherwise, a lot of links to other videos in the description below. Thanks for joining me. Do subscribe if you're new here and you want to be notified when I post new videos. I'd love to hear from you in the comments below if you have questions, and otherwise, I'll see you next time. Bye.